All right, this is not a celebration video. This is not a victory lap video. And this is definitely not a lazy ceasefire is here so risk is over video. This is a market risk video. Because one set of headlines hit the tape, silver jumped, oil got crushed, stocks ripped higher, and a lot of people instantly acted like the danger was gone. But markets do not become safe just because one headline sounds calm for 6 hours. Because yes, the relief move was real. On Wednesday, Wall Street exploded higher after the 2-week U.S Iran ceasefire announcement brokered by Pakistan. The Dow finished up 2.85% at 47,910.79. The S&P 500 rose 2.51% to 6,782.83, and the Nasdaq closed up 2.80% at 22,635. Oil got smashed below $100. That happened. The market loved the headline. But the deeper question is whether that move was pricing reality or pricing hope. And before we go further, a quick word to the people who watch every single move but still have not subscribed. YouTube stats always show the same thing. A huge number of regular viewers still are not subscribed. So if you get value here, support the channel, subscribe, and leave a comment when you're done. And while you're at it, join the WhatsApp channel as well, because when these market headlines start moving fast, that is one of the easiest ways to catch the quick updates before the next big candle prints. Now here's the first thing that matters. The rally was built on a ceasefire headline, but Reuters' own explainer said the basic question was still unresolved. Is there actually a ceasefire in a meaningful sense? Reuters reported that the U.S. and Iran agreed to a 2-week pause, but fighting was still going on the next day. Israel launched major strikes in Lebanon, and the U.S. itself said it could resume fighting if the push for a lasting deal fails. That is not stability. That is suspended panic. And if you are wondering why I am pressing that point so hard, it is because silver does not trade in a vacuum. Oil does not trade in a vacuum. Stocks do not trade in a vacuum. They all reacted to one assumption, that the war premium was about to fade. But if the underlying conflict is still active in nearby theaters, if the choke point is still not clearly open, and if the actual peace terms are still being argued in public, then the first move can still be the wrong move. That is why I do not want people looking at a green candle in silver and thinking the whole story is solved. As of Thursday, Reuters quote data showed spot silver around $73.83, while Reuters metals coverage had spot silver near $73.93, down slightly on the day even after the earlier relief move. In other words, silver responded, but it was not acting like a market that had suddenly received clean certainty. It was acting like a market still trying to decide whether the headline was durable. And when I say durable, this is what I mean. Reuters reported Thursday that Brent crude was back up at $98.44, and WTI was back up at $97.88 after the prior session's collapse. So oil did not just fall and stay buried. It snapped lower on relief, then started climbing again as traders looked harder at the details and realized the Strait of Hormuz was still restricted and the broader ceasefire still looked shaky. That bounce matters because oil was the cleanest pieces here trade on the board. So if the cleanest trade already started wobbling, what does that tell you about silver? It tells you the market may still be caught between two competing forces. On one side, the relief trade says lower oil, calmer inflation fears, lower stress, better mood, risk on. On the other side, the fragile truce trade says nothing is settled, supply risk is still real, inflation pressure can come right back, and safe haven demand can return in a heartbeat. That is not a simple trend. That is a tug of war. And this is where a lot of traders get trapped. They think the first move is the final move. They think the gap tells the whole story. They think the chart is speaking clearly, when the chart is really just reacting to a news pulse. But in headline-driven markets, the first reaction is often just an emotional draft. The real test comes later, when details start leaking out, when conflicting statements hit the wires, and when traders are forced to ask whether the original assumption was even correct. Because the details are messy. Reuters reported that Israel and Washington say Lebanon is not covered by the truce, while Iran and Pakistan say Lebanon was explicitly part of the deal. That disagreement is not a side note. That is central. If one side thinks the ceasefire covers Lebanon and the other side says it does not, then the market is not pricing a fully shared agreement. It is pricing different people describing different deals with the same word. And this is exactly why the move in silver deserves caution, not blind celebration. A relief bounce based on a clean ceasefire is one thing. A relief bounce based on a ceasefire that the parties themselves are interpreting differently is something else entirely. That kind of setup can still produce upside. Of course it can. But it can also produce violent reversals because the market is trading confidence before it has clarity. Now add one more layer. Reuters said there was no sign Iran had lifted its blockade of the Strait of Hormuz as of Thursday morning, even as peace talks were supposedly moving forward. Reuters also reported that this waterway typically carries about 20% of global oil and gas supply. That number is why this story matters far beyond one regional headline. If that artery is not clearly functioning, then the market cannot just assume energy stress disappears because one political statement sounded better than the previous one.
In fact, Reuters' ceasefire explainer made it even more blunt. It said the strait was not yet open in a normal sense. A few vessels had passed with Tehran's permission, but shipping sources said threats still remained, and Hapag-Lloyd said it could take at least 6 weeks for traffic to return to pre-war levels. Think about that. Even if the headline says ceasefire, the market plumbing says disruption can linger. That is the difference between a slogan and a supply chain. That matters for silver because silver is not just a fear trade. It is also part inflation hedge, part monetary metal, part industrial metal, part policy trade, part liquidity trade. So when oil falls, silver can lose some immediate panic premium. But when markets begin to doubt that the oil move can last, silver can catch a bid again from the uncertainty. That is why these violent push-pull phases are so dangerous for anyone trying to make one-directional predictions from one candle. And now let's talk about stocks, because this is where people can get lulled into comfort. Wednesday's move was huge. The Nasdaq up 2.8%, the Dow up more than 1,300 points, the S&P above its 200-day moving average for the first time since mid-March, according to Reuters. That is a real relief rally. I am not minimizing it. But relief rallies are not the same as solved problems. Sometimes they mark the beginning of a bigger rebound. Sometimes they are just the market taking a breath before realizing the original threat is still alive. And Thursday already showed how quickly that mood can turn. Reuters reported that global stocks slipped as doubts about the truce pushed oil back up. AP reported the same broad theme. Oil rose again on Thursday, and world shares retreated as skepticism over the ceasefire grew. So within roughly one session, the market went from huge relief to, hold on, not so fast. That is exactly the kind of unstable backdrop where silver can fake people out in both directions. That is also why I do not want anybody going all in because one move looked clean for one day. In this environment, cash is a position, physical metal is a position, patience is a position. What is dangerous is emotional overcommitment, because if the truce strengthens, some hot money can leave metals and chase risk. But if the truce weakens, the same market can reverse violently, and the people who bought late into euphoria usually get punished first. And while we are on the subject of discipline, by the time you are watching this, the members-only video should already be live. If you want the full timeline, the deeper scenario map, and the extra layers we cannot always fit into one public upload, join the membership and watch that full update in one place. That is where we can go more in depth on the moving pieces. And honestly, it is also how I can tell who is really following every twist in this story. Now, one of the most important things in the entire setup is not just that talks are coming. It is that even the timing around those talks has looked messy. Reuters reported that Caroline Leavitt said the first round of talks in Pakistan would take place on Saturday, and that the U.S. team would be led by Vice President J.D. Vance. At the same time, other public reporting earlier in the cycle pointed to Friday. Even the schedule around diplomacy has been fuzzy. That tells you how fluid the whole situation still is. And if the schedule is fuzzy, imagine the substance. Reuters reported that Iran is demanding an end to all fighting in the region, including Lebanon, along with sanctions relief, continued influence over the strait, and the right to keep enriching uranium. The U.S. position is sharply different. Halt enrichment, remove existing stockpiles, curb missiles, and cut off support for regional allies. Those are not small differences. Those are foundational gaps. That is why I keep coming back to one line. The market is trying to price peace before the terms of peace are even agreed. And that can work for a while. Markets do that all the time. They front-run the possibility. But when they front-run a possibility that later runs into hard political disagreement, the unwind can be brutal. That is why I would rather be early to caution than late to panic. And another thing. Reuters reported that Israel's biggest attacks of the war on Lebanon killed more than 250 people, and Hezbollah said it was resuming attacks after initially indicating it would pause in line with the ceasefire. If the Lebanon front is active, if both sides are talking past each other on whether Lebanon is covered, and if Tehran is saying there will be no deal while Israel keeps striking Lebanon, then the market cannot honestly say the regional risk is behind us. This is why I think the better framework is not ceasefire equals bullish everything. The better framework is ceasefire changed the immediate temperature, but it did not remove the structural risk. That is a very different message. One message creates complacency, the other creates discipline. And in fast markets, discipline usually outlives excitement. Now let's bring silver back into the center. Silver is tricky here because it can be pulled in opposite directions almost at the same time. If the market believes war risk is fading and oil pressure is cooling, that can reduce fear-driven flows. But if the same market also starts worrying that inflation is still sticky, the Fed could stay tighter, growth could wobble, or geopolitical stress could come right back, then silver can remain attractive as a hard asset alternative. This is why simple narratives keep failing in complex macro moments. And the macro layer is not quiet either. Reuters reported that the Fed minutes released Wednesday showed growing openness among policymakers to possible rate hikes because of inflation risks tied to the oil shock. Reuters also noted that February PCE data was due on Thursday and March CPI was due on Friday. So while traders were cheering the ceasefire headline, the rate backdrop was still warning that inflation pressure has not just disappeared. That is a huge deal, because silver does not only care about war headlines, it cares about real rates, inflation expectations, liquidity conditions, and whether investors think central banks are behind the curve. If oil had truly collapsed and stayed down, maybe the inflation panic eases. But if oil snaps back, while the Fed is already sounding more cautious, then the market gets squeezed between growth fear and inflation fear again. And silver can get very interesting in that kind of mess. Now, none of that means silver has to crash. None of that means the breakout has to fail. And none of that means the ceasefire will definitely collapse. What it means is simpler than that. It means certainty is still being oversold. The boldest voices online always want to give you a final answer on a still moving story. I do not think that is how you survive this kind of market. I think you survive by separating the first reaction from the durable trend. And if you are one of the people doing well right now, whether in business, investing, or life in general, share that in the comments too. Seriously. A lot of people read this channel quietly, and hearing from someone who is actually making progress helps lift everybody else. That kind of comment section matters more than people think, because strong communities keep people steady when markets get noisy. Here is another reason I am staying cautious on the all-clear narrative. Reuters reported that the physical price refiners were paying for real barrels of oil had surged toward record levels near $150, even while benchmark futures cooled after the ceasefire headline. That split is important. Futures can react to hope. Physical buyers react to actual shortage, shipping friction, insurance costs, and real delivery pressure. When those two things diverge, headline traders can get blindsided, and that is not just an oil point. It is a market structure point. When paper markets move one way and the real-world bottlenecks have not actually cleared, you can get a relief rally that looks powerful, but is still built on a weak foundation. That is the kind of environment where a chart breakout can still turn into a head fake. The move looks obvious on the screen. Then the plumbing reasserts itself. Then everyone has to reprice. Reuters even quoted an analyst saying the futures market looked a bit broken because prices should have snapped fully back to pre-ceasefire levels if the market really believed the reopening path was clear. That line tells you everything. If the market itself cannot fully price a clean reopening, why should you assume silver, oil, and equities have already found their final post-truce levels? And then there is the Lebanon issue again, which I do not think can be overstated. Reuters reported that Britain and France said the truce should extend to Lebanon. In other words, it is not only Iran saying the Lebanon question matters. Other countries are looking at the same gap and saying the ceasefire is not really complete if that front stays active. That is another reason the early euphoria looked too clean for a situation this messy. Now let's make this practical. If you are a long-term stacker, you do not need to turn every move into a drama. Your job is not to be perfect. Your job is to stay solvent, stay patient, and stay consistent. If silver dips hard, you do not need to panic if your core thesis is longer term. If silver confirms strength, you do not need to chase recklessly either. You can scale. You can dollar cost average. You can keep powder dry. That is how adults handle volatile markets. If you are a short-term trader, though, this is a much harder tape. Because in a market like this, a single headline can erase 2 days of beautiful chart work in 20 minutes. That is why the phrase, headlines beat technicals, matters so much right now. The chart is useful, yes, but the chart is living downstream from diplomacy, military moves, shipping constraints, and policy messaging. And every one of those can still change fast. That is also why I think people need to stop talking as if the market just solved risk in one session. Reuters reported that on Thursday there was still no sign the Hormuz blockade had been lifted, and AP likewise reported that oil was rising again as skepticism toward the ceasefire spread. If the market were truly convinced the path was now clear, you would not expect that kind of immediate rebound in crude. You would expect a cleaner unwind of the risk premium. Instead, what we got was a more revealing pattern. The first move was a burst of relief. The second move was doubt. And the third move, which we are entering now, is probably going to be about credibility. Are the parties actually moving toward a durable framework, or are they simply buying time while still fighting around the edges?
That question will matter more to silver than the first spike did. And let me make one more distinction that I think is important.
A lot of people treat silver as if it only wins when everything is falling apart. That is too simplistic. Silver can do well in panic, yes, but silver can also do well when investors start doubting fiat, doubting policy control, doubting the growth outlook, or doubting central bank flexibility. It can also suffer short-term when rate expectations rise and traders de-risk indiscriminately. That is why you have to think in layers, not slogans. Reuters also reported that New York Fed survey data showed one-year inflation expectations jumping to 3.4% in March from 3% in February, with gasoline price expectations surging sharply. So, even before we get the full post-conflict inflation read, the public expectation channel has already been heating up. That matters because once inflation expectations move, markets stop assuming central banks can glide gently back to easy policy. And if central banks cannot glide, what happens? Financial conditions tighten. Equity markets become more fragile. Growth assets lose some cushion. Hard assets get another reason to stay in the conversation. Again, I am not saying it is a straight line. I am saying the bigger silver story does not disappear just because one ceasefire headline triggered one relief trade. If anything, this whole episode reminds you how unstable the macro base still is. Now, I know some people want a simple answer. So, is silver bullish or not? My answer is that the long-term case can remain strong while the short-term tape stays dangerous. Those two things can coexist. They often do. The mistake is when people hear short-term caution and assume it means long-term bearishness. It does not. It means the road can still be violent even if the destination eventually ends up higher. And yes, by the time you watch this, make sure you check the WhatsApp channel too, because this is exactly the kind of story where the market can turn between uploads. I would much rather get you the short update quickly than make you wait for the next long-form video while the tape is already moving without you. Now here's where stocks become a real tell. Wednesday's relief rally was strong, but if the truce keeps fraying and oil keeps recovering, equities may have to revisit the simple math again. Higher oil means renewed inflation pressure. Renewed inflation pressure means the Fed stays less friendly. Less friendly Fed plus geopolitical uncertainty means multiples can get squeezed. That chain does not guarantee a sell-off, but it absolutely prevents me from treating Wednesday's rally like a final verdict. And to be clear, Reuters did not just describe the policy mood as neutral. The minutes showed a growing openness to rate hikes. Think about that. The market wants cheaper oil, softer inflation, and easier policy. But the central bank discussion was moving in the opposite direction because the war shock had already changed the inflation picture. That is not the backdrop for blind complacency. This is why I keep saying, do not confuse a squeeze with a settlement. Relief rallies can be violent because positioning gets caught leaning the wrong way. Shorts cover, vol sellers relax, dip buyers jump in, everything moves at once. But a squeeze is not proof that the underlying issue has been resolved. It is only proof that the market was positioned too defensively for one headline. After that, reality still gets its chance to speak. And reality, so far, is not exactly whispering calm. Reuters said Israel continued striking Lebanon. Reuters said Hezbollah resumed attacks. Reuters said there was still no sign of a normal Hormuz reopening. Reuters said physical oil remained extremely stressed. Reuters said the core disputes between Washington and Tehran remain unresolved. Put all that together and tell me this looks like a risk-free environment. It does not. It looks like a pause with teeth. Now, if the talks in Pakistan actually produce a clearer framework, if the Lebanon question gets resolved, if transit through Hormuz normalizes, and if crude starts losing premium for real, then yes, the market can build on the relief move. I am open to that. You should always stay open to new evidence. But until that evidence is actually there, I am not going to pretend that the first wave of optimism settled the whole case. And here's another thing worth remembering. Reuters reported that WTI had posted its biggest one-day decline since April 2020 in the previous session. Moves that extreme are not normal. They tell you this is an unstable market, not a calm one. Extreme moves can be followed by more extreme moves. That applies to oil, to stocks, and yes, to silver. When volatility gets political, neat forecasting usually gets humbled. So what do you do with that as an investor? For me, the answer is straightforward. Keep some cash. Keep some physical metal. Respect volatility. Do not let one green day talk you into abandoning risk management. And if silver gets knocked around because traders start repricing the truce, that does not automatically invalidate the longer-term precious metals case. It may simply create another decision point for disciplined buyers. On the physical side, I still think there is a major difference between paper emotion and hard asset discipline. When I say hold physical metal, I am not saying bet the house on one idea. I am saying own some real insurance in a world where policy, inflation, war, and liquidity can all change faster than most people expect.
Physical metal is not about winning every week. It is about not being fully exposed to promises. And that matters even more when confidence keeps getting jerked around by headlines. Wednesday said relief. Thursday said doubt. Oil down, then back up. Stocks up, then shakier. Silver up, then softer. That is not a smooth, trending environment. That is a confidence market.
And confidence markets are dangerous because they look clear right before they become chaotic. Another thing I want to say to the audience: if some of you have been quietly building something solid during this whole crazy cycle, whether that is a business, a savings habit, a disciplined stack, or a debt payoff plan, put that in the comments. Those wins matter. They remind people that even when the macro is messy, personal progress is still possible. And that kind of energy makes the whole community stronger. Now, let's deal with the biggest mistake people make in moments like this. They assume the market owes them a clean story. It does not. Sometimes you get a move that is half relief, half denial. Sometimes you get a ceasefire that lowers one kind of risk while exposing another. Sometimes silver rallies because fear drops, then holds because uncertainty remains, then whipsaws because the Fed enters the chat. That kind of mixtape is frustrating, but it is also normal in real macro turning points. If you are asking me what I am watching next, I am watching three things above all. First, does oil keep rebuilding premium, or does it roll over again? Second, do the Pakistan talks produce a more coherent public framework, especially on Lebanon and Hormuz? Third, does silver start acting like a metal with sustained conviction, or like a market that just got pulled around by the first relief wave? Those are the tells. Because if oil stays bid, that tells you the market still does not trust the supply outlook. If the diplomacy messaging stays contradictory, that tells you political risk remains unresolved. And if silver cannot hold its footing while those two things are in play, then it is telling you traders still see this as a tactical move rather than the start of a clean new leg. None of that is mysterious. It is just the market revealing what it truly believes after the emotion fades. And one last macro point that should not be ignored. Reuters Wall Street coverage noted that the Fed minutes came out the same day as the huge relief rally. That means the market had to celebrate the ceasefire while also absorbing a central bank that sounded more worried about inflation. Usually, when two narratives clash that directly, one of them ends up dominating the next phase. So watch that very closely. If inflation fear wins, silver can stay in play even if the ceasefire technically holds, because the bigger issue becomes monetary stress. If growth fear wins, silver might wobble with broader liquidation before recovering later. If true peace momentum wins and energy normalizes, then silver may need a different driver for the next leg. That is why I am not reducing this to one bullish or bearish slogan. There are multiple paths from here. Now let me be blunt. I think the people shouting "all clear" are getting ahead of themselves. And I think the people shouting "everything is collapsing right now" are also getting ahead of themselves. The honest middle ground is that the ceasefire changed the immediate market mood, but the deeper fault lines remain open. That is the kind of environment where you can still get upside in silver, but you should earn that upside with patience, not impulse. And yes, if the whole thing does stabilize more than expected, great. A durable peace is better for human beings, better for markets, better for costs, and better for the real economy. Nobody sane should root for escalation just to force a trade idea. But as investors, we also do not get paid for what we hope happens. We get paid for reading risk correctly while the facts are still messy. That is why my base message has not changed. Do not go all in because of one relief pop. Do not throw away cash. Do not ignore the value of physical metal. Do not assume the next update will confirm the previous headline. And do not let social media certainty bully you into oversized conviction. The market still has too many unresolved moving parts for that. If the next round of reporting starts showing a clean Saturday negotiation track, a real reduction in cross-border strikes, more normal shipping conditions, and a fresh slide in oil, then the market can breathe easier. But if talks stall, if Lebanon stays hot, if crude reaccelerates, or if the Fed keeps sounding firmer, then the easy ceasefire fixed-it trade is going to look very naive very quickly. So where does that leave silver right now? It leaves silver in a very interesting place, but not a simple one. There is still a long-term case for hard assets in a world of shaky geopolitics, elevated inflation sensitivity, and fragile trust in policy. But there is also a short-term tape that can still punish sloppy entries. That is the truth. Not sexy, not extreme, but true. And if you want the strongest takeaway from this whole video, here it is. The breakout story might be real. The ceasefire story might also be real. But neither story is complete yet. And incomplete stories are exactly where the biggest traps form, because traders rush to act before the evidence catches up. I would rather let the market prove more before pretending it already has. So stay sharp, stay flexible. Keep your eyes on oil, on diplomacy, on the Lebanon front, on the Strait,
and on how silver behaves when the next headline drops. Because this next move may not be decided by the chart alone. It may be decided by which story the market trusts more, relief or reality. And if you got value from this, do two simple things. Subscribe to the channel if you have not already, and drop a comment below so the algorithm knows this content matters. Then check the WhatsApp channel, and if you want the full, deeper breakdown, join the membership because the members-only update should already be there waiting for you. For now, I am not calling the danger over.
I am calling the situation active. Silver got a headline lift, oil got hit, then bounced, stocks got relief, then doubt crept back in. That is not a clean ending. That is the market telling you the next chapter is still being written.